I don't have any solid numbers, but I can just feel it by looking at the tape every day. You can
Yeah.
just feel that the money's starting to come into the space. Not a lot yet, but the money is starting to come into it yet. And he said, so you don't really like it. You don't want to buy it, but you're going to buy it anyway. He said, I have to because we're underperforming the index.
What are you looking at? Do you think the U.S. economy is, and Canadian economy for that matter, finally beginning to roll over and tighten up? Or is it just, financial conditions are loose and everybody's doing great? Well, hello again from Sprott Money, sprottmoney.com. It's time to wrap up a very volatile month of May with your monthly wrap up. I'm your host, Craig Hemke. Joining me is our old friend, Bob Thompson, a senior portfolio manager with Raymond James in Vancouver. Bob, a good friend of the show, good friend of Sprott Money, good friend of Eric Sprott. So it's always fun to pick his brain a little bit. Bob, good to see you, my friend.
Great to be on again, Craig, and tough act to follow when you had Eric on a few weeks ago. So we'll see how we do.
He's always full of good information too, no doubt about it. And hey, before we get started, again, we're now wrapping up May. Pretty soon we'll be moving into June. Remember, all this content comes at you from Sprott Money. And right now, if you are an existing customer of Sprott Money, go to sprottmoney.com, refer a friend, and save as much as $500 on your next order. Hey, that's not a bad deal. So again, go to sprottmoney.com, check that out. All kinds of great deals there as well. They are the sponsor of all this content. Thank them for that content. And we'll look forward to June. But before we get to June, we got to wrap up. Man, what a month it has been, Bob. We watched gold break out of its almost 4-year trading range back in March and shoot higher. We waited patiently for silver to do the same, and it did so a couple of weeks ago. What is going on here? What do you think is driving all this, Bob?
Yeah, it's interesting. A lot of talk about buying in the East and that sort of thing, but I think the psychology of this is really important. When interest rates go up, gold doesn't do very well. So, yeah, but it still did okay in 2022, 2023, right? The stocks didn't, and that's because of this demand that's there for the metal. But here's what's interesting. We'll talk about this, I think, a little bit later. This demand from the East, people in China, people in India, people are looking for a better lifestyle, trying to, their currency may be dropping, hard times, so they're putting their money into gold and silver. They don't care what the COT is. They don't care what the commitment of traders is. They don't care about ZIRP, zero interest rate policy. They don't care about NIRP, negative interest rate policy, and they don't care about PERP, which is positive interest rate policy. It doesn't matter to them. What they care about is that they want to acquire silver and gold. So, the futures markets were not made to control the price of a metal. The futures markets were made so commercial companies could sell forward their grain or their oil or whatever and lock in a price for themselves to make sure that they were profitable, they could control their costs. And now it's got crazy where it actually controls the underlying metal. So hopefully we go back to the supply and demand, which is important. But we'll talk about the shares a little bit later, but I just wanted to mention that again, this demand from the East, which is pushing silver and gold up, those people don't buy the stocks. They don't care about owning a gold stock. They care about owning a metal. Who are the people that are interested in buying the stocks? It's Western portfolio managers, hedge funds, mutual funds, etc. Well, guess what? They aren't ready. They aren't ready yet to buy because they're saying real rates are at very high. Gold shouldn't be up. It's not up. It shouldn't be up. I'm not going to buy gold stocks. Right. So I think that's the differentiation is the end buyer is a different end buyer for the equities and the metal, and the end buyer for equities, they aren't ready yet. They got caught by surprise here.
Well, and you mentioned a good point about this physical demand. Even the Silver Institute, as they estimate the last 4 years, is a supply deficit of 700 million ounces now. 100 million 4 years ago, and each of the last 3, if you want to average it out, about 200 million. And that is not factoring in Eastern demand so much. Oh, sure, industrial demand, but not this investment demand either. We've talked for a while, Bob, ever since the Shanghai Gold Exchange opened 10 years ago, about whether that Eastern physical market would place pressure and ultimately maybe make the Western paper markets irrelevant. Do you think we're trending that way finally?
I think it is. And in markets, they say risk happens slowly and then all at once, right? And
Yeah.
it's the same thing. It's kind of that complexity theory. So things are building slowly, and then suddenly you get this surge. And let's go back, because I was talking to Maria Shmernova, and she manages for Sprott, their silver equities fund. And you know, we were having a great chat. I talked to as many people as I can. You always get a tidbit of information. You get 1% from every person. You increase your knowledge by 100% over time, right? And Maria mentioned to me, she said, you know, we've had 4 years of this silver deficit, right? We all know that. Everybody knows it. Why isn't the price going up? She said the same thing happened with palladium. There was a 4-year deficit with palladium, and everybody was wondering, why isn't palladium going up? Why isn't palladium going up? And then suddenly, you know, in 5 years, 2016, it was 500, and it went to 3,000 in 5 years, right? So that was a multi bagger. And once it happened fast, and it comes very, very fast. And I think that's important. And, you know, just one more thing to give an analogy. My little 6-year-old, I have to read to him every night before bed, and he loves to hear about the Titanic. He's infatuated with the Titanic. So I was reading to him a few weeks ago, and they said, you know, with the Titanic, this unsinkable ship, as it was starting to go down and all the people were on the deck, they were still playing jovial music. The band was still playing jovial music, because this is unsinkable. It's just an exercise we're doing. That reminded me, that's what's happening right now. We have the signs, the ship is tilting, but they're still playing jovial music. Everything's wonderful, everything's great. Then what happened when everybody realized that the ship was going down? They played Amazing Grace. And that was it. And they knew that that was it. And the ship went down a few minutes later. They're not playing Amazing Grace yet. They're still playing jovial music with the economy, but it's coming. It's coming.
Well, and to that point, as we begin to look ahead to next month, you know, this June FOMC meeting is looming in a couple of weeks.
Mm-hmm.
Every quarter on the quarter, you get a summary of economic projections where all these goons all get together and they say, well, I think unemployment's going here, and I think that inflation's going there. And they put it all together into a table, and that somehow is just, you're supposed to discern what's going to happen. But that's what the market looks at. What are you looking at? Do you think the U.S. economy is, and Canadian economy for that matter, finally beginning to roll over and tighten up? Or is it just, you know, financial conditions are loose and everybody's doing great?
Yeah, you know, and I don't focus on too many of these meetings. I look at the big trend, and the big trend is we're a lot closer to interest rate decreases than we are to significant interest rate increases, right? They might hike rates once more just to scare everybody, but we're a lot closer. The trend is that the rates are going to have to come down, especially after the election. So looking at that, I mean, that's a big tailwind for metals. If we have to fight a little bit here for a few months again, then so be it. It'll be a great opportunity to buy some more. But I do think, you know, people in our industry a lot of times have way too short of an investment horizon, right? Look out, as Stanley Druckenmiller says, what's the world going to look like in 18 months, and invest like that now? Well, I think in 18 months, the economy is going to be a lot weaker. If it's not, then they're going to be running $3 trillion deficits a year, and something's going to break when they do that, right? So, I mean, I think most of the listeners here, and I'm sure no sympathizer for the central banks, but if you were trying to raise interest rates and slow things down, like the central bank's supposedly been trying to do, and then the government's running a $2 trillion deficit, they're fighting you, right? By giving money to everybody. Well, no wonder the economy is still kind of afloat, because they're just blowing their brains out on the fiscal side, right? And that's for political reasons, election years, all that sort of stuff. But all that comes to an end sooner or later, right? So I think when rates start to drop, or they do yield curve control or something, because you can't continuously run $1 trillion a year in interest payments. That's going to be a huge tailwind. And hopefully that's when the Western investors say, wow, now it's time to buy gold stocks and silver stocks.
Well, Bob, you've walked me perfectly into where I wanted to go with this. You're such a good guest. You'd mentioned earlier the retail fund manager and the hedge fund and the family office and everything, looking at the gold price and going, wait a second, real rates, at least as they're calculated, are positive. So I can't buy gold stocks yet, but you just described a scenario where real rates will be going negative. And all of a sudden, there's going to be a lot of catching up to do. We're not seeing the catching up yet. So in the latter half here of this podcast, let's start with your mining clock. the Bob Thompson proprietary mining clock. Tell everybody where you think we are, and then we'll start to kind of bust out some of the internals from there.
Yeah, you know, it's been stuck in neutral or in reverse for a couple of years, right? The clock doesn't move like normal clocks. It stops,
Broken.
moves forward, jumps ahead, etc. But we are in a bull market. We are in a bull market. If you look at the price of gold, you know, 2015, it reached 1,050. It's been a tough bull market, and you never know you're in a bull market until the latter part of a bull market. Right? When you're comfortable and you're sure you're in a bull market, you better be kind of scaling back and getting out, because nothing's for sure. As you think, things climb a wall of worry, and that's what's been happening in gold and silver. So the mining clock has been progressing forward. We're probably around, still around 7 o'clock right now, 6:37. You know, when do you sell? 9:30, 10. You don't sell everything, because you do get that parabolic move up at the end of a cycle. But we got a long way to go here, right? There has to be a lot of exploration. There has to be a lot of money raised. You have to start getting substantial M&A, and that's starting to happen, not necessarily in gold and silver as much, you know, but BHP is making a big bid for Anglo, and, you know, it's starting to happen in the commodity space. So as we move forward there over the next few years, you're going to see more and more and more money spent. You're going to see more M&A, more discoveries, hopefully. And when that starts to happen, and people start to, and these companies start to spend their money like drunken sailors, right? And overbid each other for other companies, do these stock or stock for stock takeovers, et cetera, using their overvalued stock to buy somebody else's overvalued stock. That's telling you you're getting near the end. Might be some parabolic growth after that, and we're a long way from that. So I hate to, you know, people scratch their heads and say, we're not even in the beginning of a bull market yet, and he's talking about when to sell. No, not at all. You just got to be aware. We're a few years down the road, but this is a cyclical industry, and you have to be prepared for that. And that's the mindset. And I talk a lot about psychology, because there's no way that you could hold through all this volatility unless you're a true believer, right?
Right.
And that's great. But if you're a true believer too much, you don't see the signs at the top, right? And you're so entrenched, and you do the round trip all over again, right? So that's a lot of what we do in our business, right? When dealing with senior mining executives, we kind of remind them, hey, this is a cyclical business, so let's make sure we have your legacy for you, et cetera.
So at 6:37 on the clock, people, I'm sure that own the mining shares, are looking around, they're going, okay, well, my exploration companies haven't really moved yet. Even though gold's $2,400 an ounce, they're still raising cash to have enough money to drill things out, prove things out. So there's no rush there yet. Some of the bigger ones, you know, have moved, like Newmont's moved up 30%, but at $40 a share, it's basically the same price it was 20 years ago.
Right.
All right. So where's the sweet spot at 7 o'clock? Is it a like a mid-tier kind of junior producer? I mean, what kind of
I think we're still in the special situation area, right? So companies that got great discoveries, you know, I don't want to talk individual stocks, but there's been a few big winners that have had some great discoveries. So money's coming into those ones, but people are still kind of looking for those big winners, right? They're not willing to invest in the whole space. So the big winners have done well. I think the senior companies, people have been burned by them many times from the last cycle. But I think this quarter, next quarter, you know, Newmont, Agnico, Barrick came out with relatively good earnings, right? And the markets are going to have to start to look at that, right?
We think.
And when they look at that, Newmont's the first they go to, because it's the only gold stock in the S&P, right? So money goes there, and then people say, okay, I'm willing to go into the other stocks. But here's I think what's super important, Craig, is that we're in a bull market already. People just don't realize it. I know the juniors haven't moved yet, but there's a lot of reasons for that. The Russell 2000, microcap stocks, even outside of our space, small cap stocks have done horribly all around the world, and there's lots of reasons for that. But, you know, the gold and silver small caps are kind of lumped in with all the other small caps in the world in every sector. They haven't done well. Their time will come. But I think what's important is that, you know, as gold starts to move, then money starts to go into silver. You've talked about the gold stocks are a lot more related to the silver price than they are to the gold price. And I think that's maybe an accidental correlation, because gold stocks start to move later in the cycle, and silver starts to move later in the cycle. with gold stocks. So I think, you know, that's what's important. Also, we still have these big stocks like Nvidia and all these things. People are still racing to get those stocks, right? Hedge fund managers get paid quarterly performance bonuses, right? So they're going to chase whatever is doing well now so that they can make as much money as they can now. I mean, that's their time horizon. So when these stocks start to roll over, when there's no money to be made there anymore, they don't even have to drop a lot. They just have to kind of go sideways and not do anything anymore. Then they're going to look for other areas of the market. And that's when the capital flows start to come in. And I've been doing this 30 years. I don't have any solid numbers, but I can just feel it by looking at the tape every day. You can just feel that the money's starting to come into the space. Not a lot yet, but the money is starting to come into it yet. And you know what's going to shock a lot of people? We are already in a substantial bull market that has beaten the S&P 500 over the last 5 years. So if you take a look at XME, XME is the metals and minerals ETF in the US, not just precious metals, but it's all metals and minerals. It's up over the last 5 years by about 165% since mid 2019. The S&P over that time frame is up around 85%. So it's almost doubled the S&P already, and nobody even knows.
Nobody, heck, I didn't know.
Everybody thinks the S&P 500 is the best place to be. No, not at all. That you would have doubled it in the last 5 years in the metals and minerals ETF. So those are big stocks. I'm not talking about small stocks. Right? Those are the bigger stocks. But again, money flows downhill. So again, we're in a bull market and nobody even knows it. Now, when everybody knows it and everybody says, you know, this is the only place ever to invest, you know, guess what? Should be time maybe to look other places. But we're a long way from that.
Yeah, and probably need, you know, like you said, gosh, if silver could only get above 30, you know, that all these things are happening. Gold could break out and we still don't get that momentum. But just one last question for you. And I guess it's two-pronged. At what point does the growth of the explorer and the mining company begin to look preferable to owning the streamers and the royalty companies, you know, in kind of a seesaw? On a bigger picture, at what point does the value of the gold miners begin to become more attractive than the growth of the Nvidia? Or do those kind of things all factor into a bigger outlook as to what could drive the shares finally?
Right. I think the big mistake that people make is, you know, relative valuation, right? So if something is growing at 20 times and the market's willing to pay 60 for it, you know, that's what they call a PEG ratio, price earnings growth. You're 3 to 1. That's fine. I mean, it could go to 4 to 1, whatever the case is. But sooner or later, it gets to the point where it's exhausted, right? The amount of money that can go into that sector gets exhausted. When that happens, I mean, it's just mathematical. I mean, it stops going up, right? And it starts to go down as people start to take profits. And then they look at other sectors that are trading at very, very low valuations. But I'll tell you what we're in the middle of right now, and I think this is super important. I follow a commodity hedge fund manager in the US, and he said he went out with a buddy of his recently that is a generalist portfolio manager, right? So he doesn't invest in anything other than, you know, index or stuff. And he said during their coffee, he was absolutely panicked, this generalist portfolio manager. He was actually sweating and he's looking at his phone and his friend said to him, what are you doing? We're trying to just have a coffee here. He said, this NVIDIA thing, I got to buy it. I have to buy it. I got to get in. He said, whoa, what? Do you like it? Do you want to buy it? He goes, no, I don't, but I got to buy it. Because he said, it's 5% of the benchmark or whatever the case is. And we're underweight and we're underperforming the market. We got to get in to get market weight. And he said, so you don't really like it. You don't want to buy it, but you're going to buy it anyway. And he said, I have to because we're underperforming the index, right? So when everybody gets a market weight of things like that, then, you know, they're probably not going to go over market weight. And that's when the end of the cycle happens. I don't know when that happens, but, you know, Paul Wong, who used to manage money with Eric, told me that about gold stocks. We were talking about a long time ago. I said, when do you sell? He said, you sell when the generalists have a market weight in gold stocks, because generalists are never going to go overweight in gold stocks. Right. But they will. Right. But he said, if they're missing out, they will go to a market weight. You know, right now their weight is 0. So I don't think we have anything to worry about. But when their weight gets up to 6 or 7 or 8 or 9 or 10%, which is what the TSX index is, you have to start saying, oh, who's coming in to buy after this?
Right. That,
Right.
you know, it's frustrating for many of us, you know, because you think, wow, we should be doing, but at the same time, if we're confident about where price is headed, I don't want to make it sound like it's inevitable, but it probably is inevitable that there will be a time for all these things to shine. The hard part is knowing which ones to buy. You've got to have some, you know, people working on your side to help you through that. That's all part of what's fun about being friends with Bob. Bob, you have something you crank out. Is it once a month, your newsletter called The Gold Digger?
Yeah, it's called the Gold Digger, and we talk a lot about the mining clock. We talk about where we are in the cycle. We don't mention individual stocks very much because, you know, everybody's goals and objectives are different. And I should say
Right.
that, you know, nothing I'm saying here is advice, right? So everybody's got different goals and objectives. But you know, if people are actually looking at, you know, the news releases out there on individual stocks, you're going to see something, and you're going to see that Eric Sprott has taken some significant weights and increased his exposure in some silver stocks. Now, Eric has one saying, and that is press the bet. When things are going well, press the bet and increase your exposure. He's right in the middle of that right now. You can see that some of the news releases. So, you know, I think that's a positive sign for our industry.
No doubt. And again, your newsletter is free to anyone. How do you get registered for that?
Sure, it's just Thompson Investments at raymondjames.ca. It's important to .ca because we're in Canada, but Thompson Investments at raymondjames.ca. Yeah, we'll certainly put you on the list. We come up with chart of the month, lots of great things, lots of links. So
Awesome. Send you an email at that
Yeah.
email address. And again, Thompson with a P.
Thompson with a P, exactly. That's
Got it.
right.
All right. Well, Bob, it's always so much fun to visit with you. And I always learn something. And I'm sure everybody else does too. So thank you for your time. I want to thank everybody for watching. We've now come to the end of May. Gosh, we're almost halfway through the year, which is just remarkable. It's going to be another busy month, though, in June. No doubt about that. I mentioned that Fed meeting. Gosh, who knows what the impact of Shanghai and the East is going to have the silver price. Keep an eye on this Sprott Money channel. We will, of course, have another monthly wrap up at the end of June. We'll also have Ask the Expert. We'll have the monthly precious metals projection with Chris Vermeulen. If you missed that a couple of weeks ago, go to Sprott Money, click on Insights and Podcasts and find it. Boy, Chris did a great job of laying out where prices might go from here. So you're going to want to watch that too. And we'll have another episode in June. So what I'm getting at is subscribe, maybe like the content wherever you're watching this, YouTube or whatever, so that as this stuff comes out, you'll be sure to be notified you won't miss anything. And it's going to be a busy month. Bob, thank you so much for your time. It's always fun to visit with you, and I'm sure we will do this again soon.
Thanks again, Craig. Talk to you next time.
Let's do it. And again, from all of us here at Sprott Money, sprottmoney.com, thank you for watching. We'll have more content for you next month.